Hello and welcome to Insight is Capital. I'm Pierre Daly, Managing Editor at AdvisorAnalyst.com. Joining me today is Alfred Lee, Director, Portfolio Manager, and Investment Strategist at BMO Global Asset Management. 2022 was a challenging time in markets, which had investors riding on waves of uncertainty. As we begin the new year, we'll discuss if inflation and interest rates are trending in the right direction. We'll discuss portfolio strategy and fixed income strategy. We'll explore the 2023 market outlook, central banks, gold, key risks, and portfolio construction across various asset classes.
This is the Insight is Capital podcast.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of AdvisorAnalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Alfred, welcome. It's great to have you. Happy New Year.
Good to see you. Happy New Year.
2022 was one of those rare moments in markets, in market history, where both bonds and equities nominally suffered as much as double-digit losses or more. We'll call 2022 the terrible twos. There's been a lot of buzz about the traditional 60-40 portfolio being broken for some time, and that was true in 2020. That was, one of those rare, brutal moments. And definitely it was true last year in 2022. Only now the difference between 2020 and 2022 is that we actually have more time now than we did in 2020 to make meaningful changes. We've seen investors to the move or shift to the short end of the yield curve now to take a break from risk and take advantage of also short-term yields, which we didn't have for a very long time. Was that the right move, or is that simply what investors did in reaction to rising rates and volatility?
I think in 2022 was definitely the right move. I mean, when you look at the majority of the year last year, the yield curve was essentially flat for the majority of the year. I mean, obviously we got the inversion of the yield curve heading into the fourth quarter of last year. But, as I mentioned, for the majority of 2022, because we had a flat yield curve, a lot of investors weren't really compensated for taking on term risks. So usually when you look at advisors, their books are usually kind of hugging the short end anyway, just because I think, from an advisor's perspective, they don't like volatility on the fixed income side of the portfolio. So, the short end of the curve naturally is I would say the comfort zone for where advisors like to park money. So it was definitely the right place to be in 2022. As we head into 2023, and as we're there now, you get the inversion of the yield curve. What we've been recommending is maybe taking some of that allocation, just parking some of that in the long end for now. So basically just taking a barbell approach. So maybe, 75% into something like short-term credit, which you get through an ETF, and then the other 25% in something like a long-term US Treasury or a long-term Canadian federal ETF. And I think that's a good way to play fixed income at this point.
Yeah, I mean, now that we've seen some softening up on the inflation print this week, with the inflation data coming in softer as expected and I think as hoped for. What are your thoughts on the probability and the timing that the Fed will pause on hikes? And I want to get back to the 75-25 discussion, but I'm just curious to know what your thoughts are before we get to that on what the chance, first of all, what's the probability of the Fed pausing, and I guess tied to that obviously is when.
Sure. We were saying at the end of last year, so around Q3 of last year, we did a roadshow around Canada, which is our annual economic forum. At that time, obviously, inflation was very top of mind. I was saying at that point, we're probably going to get a pause in interest rates by both the Fed and the Bank of Canada sometime in early 2023. I'm gonna stick by that call. I just think when you look at inflation, it seems to be trending in the right direction. I mean, with the CPI print, as you referenced just now, definitely trending in the right direction. We got a 6.5% print in the year-over-year number and a negative for the month-over-month number yesterday.
Yeah.
I think we're definitely trending in the right direction. I mean, the last couple inflation prints out of Canada are a little bit more stubborn, but I think we're trending in the right direction. When you look at a lot of the leading indicators, shipping cargo containers or the cost of shipping a cargo container, they often reference that one, which is back to pre-COVID levels. This is, to me, this has always been a supply side issue, right? Where, when COVID hit in 2020, everything just came to a standstill. Manufacturing came to a standstill. And a lot of people did ramp up demand, but a lot of those were one-time purchases. So things like refrigerators and whatnot, those are one-time purchases. I mean, you're not going to buy another refrigerator right now if you already did. So I think demand is going to come down just because interest rates have gone up as well. We're starting to see a lot of companies kind of report, supplies are building up. So Lululemon's a good example of this. Nike's a good example. Even if you talk to your local bike store, for example, they have a ton of supply in bikes right now, which is very different than 2020.
Right.
So what's going to happen is eventually I think they're going to start slashing prices. So that's going to be deflationary. But just going back to your central bank question, I think a pause is prudent. I think we're going to get that in early 2023. So probably, potentially as early as not this meeting, but the meeting after that. So the second meeting in 2023. There's a lot of inflation data that comes out between now and then. But if it continues to trend in the right direction, we could get it as early as then. I think it is the prudent move to do. Usually when you get interest rate hikes, it takes 18 to 24 months for those rate hikes to take in effect. So we don't even know the effects of the initial rate hikes at this point. But, as I mentioned, a lot of the leading indicators are trending in the right direction.
Yeah. So, I mean, as far as the rate hikes are concerned, I mean, that only began in May. And, of course, the market was telegraphing it ahead. And once again, now the market is telegraphing, the outlook for yields to drop as well for this year. And so when we saw some of that yesterday, and it was interesting. Also, you mentioned Lululemon and inventories, concern over inventories. There was also the rout in Aritzia, for example, which reported gangbuster profits and revenue, but then had this scary number on their inventory, which again leads to what your point about prices falling.
Yeah.
Because of demand destruction.
Yeah.
And in the in the context of huge inventories, we saw Amazon also have that problem last year as well, right?
Yeah.
Where they had Sorry, and I don't want to get into the weeds, but sorry, go ahead. You were going to say something.
No, I was just saying, where it's been a little bit more resilient is the services side, obviously, right? So I think there's some stickiness there. I think there's, when it comes to mortgages, for example, if you bought a house for, $1 million, a couple of years ago, and now you have to refinance not at a 2% rate, but a 5% rate, that cost of that mortgage is going to go up, right? So, on the servicing side, it's a little bit more resilient. Obviously, when it comes to hospitality and restaurants and whatnot, I mean, we haven't gone out in the last 2 years, right? I mean, there's a lot of people that are just trying to make up for lost time.
Yeah.
So I know my wife has been booking, 2-3 vacations at a time. And I think a lot of people out there are just to make up for lost time. So
yeah, right.
I think eventually, maybe in 6 to 8 months, when people are concerned about, employment and whatnot, I think they're going to be a little bit more, prudent in their spending on the services side. So that eventually will come down as well.
Well, yeah, and I think to put the mortgage point in question, I mean, to bring some light to the mortgage point or provide some context, I mean, if you stop and think for a moment, to go from a 2% rate to a 5% rate is a 1.5 times increase in total cost, right? It's 1.5 times more. So, a $5,000 payment now is $12,500.
Absolutely.
Right. So, yeah.
And that's some of the, I think when you look at the CPI calculation, I think that's where, it's not a perfect calculation. However, if you look at things like, real estate listings, for example, I mean, I look at it from time to time just to see where housing prices are. What I'm noticing now is that over the last couple of months, houses are just sitting there, and then they get relisted at a lower price and sitting there still and getting relisted at even a lower price. So, that to me is kind of more of a reflective, indicator in terms of what's going on in the real estate market.
Yeah.
I think eventually when that gets repriced and new kind of transactions happen there, then you start seeing the mortgage services costs start going down at that point.
I think it's pretty scary to be a central banker these days. When you have Powell, for example, Chairman Powell, keeping it he's keeping at it like Paul Volcker, right? I mean,
Yeah.
they commentators have harped on the idea that he fancies himself or wants to fancy himself as similar to Paul Volcker in his fortitude and his credibility as a credibility seeking exercise. I think it's interesting, when you look at what's actually happening on the ground, such as with mortgage rates that we've just talked about. It's hard to imagine that behind the curtain, they're they don't want to be early, and they don't want to be too late, right?
Yeah.
So there's been talk of Goldilocks.
Yeah.
When is the just right moment?
Exactly.
It's kind of nice that there was a pause in January from policy meetings, because that gives the Fed more time to reflect on what's actually happening and changes in sentiment.
Yeah.
But the big story this year looks like it's fixed income, right? It's really hard to put a finger on exactly what will happen with earnings on the equity side and other factors that are affecting, discounted cash flows, duration, arguments about, duration and what the current risk-free rates are that valuations are based on. But with fixed income, it's a little more concrete, right? We have an environment where fixed income is looking at, the prospect of falling yields. And because we have yields today that we didn't have at least for 15 years, there's a really big opportunity there. And, I think a lot gets lost in the discussion about, for example, on credit. A lot of investors, a lot of advisors, are averse to investing in credit because it has so many moving parts. At least that's what the imagination informs investors with, is that it's a complicated area. Maybe let's get back to. Sorry, I'm just babbling now. Let's get back to what you said about the allocations that you're modeling in portfolios for fixed income right now, given the environment that we're in, where yields have come up to this historically significant level, both on the credit side and on the government bond side. Maybe explain the 75-25 split that you're recommending or that you're suggesting.
Yeah, I mean, when you look at the yield curve right now, it's no longer a flat yield curve as we saw in 2022. The long end of the curve is starting to come down, which I think is a good sign that the market believes that inflation will eventually get under control. Because if the market believed that inflation was still running rampant, there would be no transactions occurring at the yield levels where they are in the long end of the curve at this point. So the good thing is that, the long end of the curve is coming down from an inflationary standpoint. The bad news, however, is that an inverted yield curve tends to indicate a recessionary environment and tends to be a pretty reliable indicator as well. So we still like the majority of the allocation in fixed income being on the short end of the curve, just because,
right.
Let's say if inflation starts ramping up again. So, China opening up is the major elephant in the room, I would say. Just because, when an economy opens up, and this is one thing that we mentioned before North America opened up last year, we said inflation was going to get worse before it gets better. And the reason why is because you could always buy something before you can make something, or you could buy something faster than you can make something. So for that reason, demand tends to come back online faster than supply. So that's why, we think the short end of the curve still makes more sense, just in terms of being overweight. If inflation does start to pop again, the long end will underperform. But at the same time, I think at this point, we have enough indication that we are relatively confident that inflation is being tamed by both the Federal Reserve and the Bank of Canada. So I think it makes sense to have some allocation on the short end or on the long end
Right.
of the curve. But at the same time, because we believe because there are growing recessionary forces out there, you potentially want to have some allocation on the long end of the curve to offset equity market risk as well. And I know a lot of people will say, well, in the last year, equities and the long end of the curve, so long federals and long treasuries, have been highly correlated. But
Yeah.
I think as the Fed starts to kind of tame down their monetary tightening, that correlation, that positive correlation between long bonds and equities will eventually break at some point this year.
That's very interesting. Are there any other aspects of fixed income that you observed that you found interesting?
No, the main thing is I think, fixed income, we've been saying, I think this potentially could be the golden era for fixed income.
Yeah.
As you mentioned, I think, when you look at, your yield to maturity on investment grade credit, for example, it's to levels that we haven't seen in a very, very long time. So let's say, for example, once we get to the terminal value, the yield to maturity on U.S. investment grade, for example, is 6.5% at that point.
Right.
When we model kind of long-term annualized return assumptions for equities, we generally use between 7 to 9%. So a lot of people could be seeing the yield to maturity from fixed income, which is a lot more of a certainty than equity market returns. And they could say, well, I'm getting a little bit less returns, but it's going to come with a lot more certainty. So why don't I just shift some of my risk over to
Right.
fixed income? So I think that I think over the next year, maybe year and a half, fixed income is going to outcompete equities at that point. But I do believe that there are certain pockets within the equity market that can perform very well.
Yeah.
I just think it's going to be a very different environment than what we've been accustomed to over the last 10 years, because in the last 10 years, it's been a very different environment where risk assets have been driven by zero interest rate policies and quantitative easing. We're reversing
Right.
all that down, where we have actual interest rates and we have quantitative tightening, which is the opposite. So, one thing that we've been noting is that everybody's saying that we are moving into a new regime, which I 100% agree with. But people are saying this is a new regime, but in fact, we're kind of moving into the old regime, which
Yeah.
more seasoned investors are accustomed to, right? Where
Absolutely.
the last 10 years has kind of been outside the norm, I would say.
Yeah. Something that favors more fundamental, more active styles of investing.
Yeah,
Absolutely.
I think, even equity factors, I think, repositioning, some of your broad beta equities into things like, more defensive growth, for example,
Yeah.
things like, low volatility and things like quality, I think, are certain factors that could perform very well in this environment.
So you actually have underweighted equities a little bit and overweighted fixed income in your models.
Yeah.
Right. And so on the equity side, let's shift gears and talk about equities now. On the equity side, what are your core holdings? What are some of your sector choices?
Sure.
And then speaking of factors, what are also some of the factor overlays that you would include in that equity allocation?
Yeah, so we're actually using factors as the core of our models at this point.
Okay, great.
So low volatility and quality, I think, are the two core positions that we've been running with the model for quite some time, at least the last 5 to 6 years.
Right.
But we continue to believe these are factors that will perform well in this environment. So when you look at low volatility, I think, as I mentioned, I think I'm very constructive of equities this year. I just don't think we're going to get that, 2008, 2020, where we're coming off the market bottom, really saw the markets take off. I don't think we're going to see that this year. And just the reason being that 2008, 2020 were really driven by QE. We don't have QE. We don't have the same level of stimulus. Stimulus is going to be, decreasing rather than increasing. And, equity markets are forward looking as well.
Right.
So I don't think we're going to get that acceleration off the market bottom. So I think, more defensive growth areas are going to perform well. So I think low volatility will be well positioned because of that. Quality I like, just because when you screen for quality, you're looking at companies that have high return on equity, low earnings variability, and low financial leverage as well. So you're looking for those companies that have strong balance sheets, don't have a lot of debt burden. So as interest rates remain high, a lot of those companies that have to service their debt and kind of, refinance, not going to be an impact to them. And at the same time, I mean, when you look at, the last 10 years, the kind of, equities that have done well are those higher growth ones, the ones that can access cheap debt and kind of just, grow their companies using low cost debt. And I think it's going to be a disadvantage for them going forward. So that's why I think I like, quality as a factor and really low volatility as those, foundations to your portfolio at this point.
Yeah, so you're cutting by going with low vol and quality, you're cutting a lot of that duration risk that was in the market last year from rising rates, right?
Yeah, exactly.
Companies with lower carrying costs or in some cases no carrying costs for debt are not going to be susceptible to interest rates remaining higher for longer, for example, right? I mean, like, I think in the discussion, one of the things that possibly gets lost is that the Fed pauses, but then they don't cut, right? That's also a possibility. They don't cut for a while. They may just pause and say, okay, we're going to leave rates at where they are right now and see what happens and watch the data, watch since they're data driven, we're going to watch what's happening. And only when we start to see, anyway.
I actually think that's a very possible outcome, though. I mean, our base case kind of right now is that they are going to pause on interest rates and then keep them there unless, things really start to hit the fan and then they really need to cut rates. I mean, them holding rates really is really just kind of, saving the bullets in the chamber if they need in order to fight a recession going forward. I mean, part of the reason why they used QE is because, they grinded interest rates basically to zero and had nothing left to stimulate the economy and had to resort to QE. So I think having learned those lessons, they're not going to fire those bullets until they actually need them.
Yeah. So I feel like just listening to the daily comment feed that comes through that there's some assumption somewhere in there that if the Fed pauses, the Fed will cut. But I've only heard a few voices actually saying, there's a very strong possibility the Fed will pause and then stay.
Yeah, and there's also, other ways in which they could stimulate the economy as well, right? I mean, there's also quantitative tightening. They could slow down the pace of quantitative tightening as well without moving the overnight rate. Also, I think when you look at currency, for example, when you look at where the Fed is right now, last year I would say the Bank of Canada was the one central bank that was ahead of them in terms of taming inflation. At this point, I think the Fed is number one, or just ahead of everybody else in terms of taming inflation, just by looking at how their CPI has moved. So I think because of that, if anybody's going to pause first, it's likely the Fed. And then when you look at other jurisdictions, Europe, for example, they're much further behind. So they're going to be hiking rates as the Fed is going to remain stable. So as a result of that, the US dollar is going to come down. So that's another way to stimulate their economy as well.
So you have factors as the core, low vol, quality. Now, are there any sectors that you prefer?
Yeah, so the one sector that we really like is Canadian banks. And the reason why is because when you look at, the valuation of banks right now, trading at PE ratios that are, very attractive versus not just the overall market, but where they have been historically as well. I mean, when you look at, just the PE ratio versus the TSX, I think it's trading at something like a 25 to 30% discount to the market. When you look at Canadian banks, I'd say arguably some of the best businesses in the world where it's basically, an oligopoly where there's limited competition, but at the same time, they're involved with every part of the economy as well. So I think, Canadian banks are well positioned. I think they've underperformed because there's an expectation that interest rates or higher interest rates is going to have an impact in terms of their earnings and their loan qualities, which, as a result of that, the banks have been writing up their loan loss provisions. But when you look at non-performing loans as a percentage of their total portfolio, really hasn't increased in the last, 12 months.
Right.
It's still at an absolute level. I think it's around, 40 basis points to 70 basis points, depending on which bank you're looking at. So a lot of that bad news has already been at least partially baked in. So we like Canadian banks. Dividend yields are still, very attractive as well. Typically when the dividend yield is above 4%, now they're at 4.5 or 4.6%. That's usually a very good buying signal historically. So, I think Canadian banks is one of the sectors that we like. Another area that we like is also energy. So when you look at energy, I think they're going through this transition. Obviously, governments obviously want them to move to kind of more renewable energy.
Right.
So if you're looking at this as a fossil fuel company, and you're obviously making pretty good margins at this point because of the demand for energy, but you also don't want to reinvest in infrastructure because you don't know, or that over the next 10 years they're going to move to more renewable sources of energy. So you don't want to spend, billions of dollars bringing new infrastructure online, which usually takes five years to build, and then another 5 years on top of that to break even. So when you look at, a lot of the Canadian energy companies, for example, you look at the cash positions, they've been accruing, and there's nothing to do with them other than pay out dividends or increase share buyback. So that's another sector we like. So those are two sectors that we hold in our model portfolios. One thing that we have on the radar, interestingly, is gold. And I think it just goes back to, what I was saying about central banks. When you look at where the Fed is compared to other central banks in terms of their quest of taming inflation, I would say they're further ahead. So the US dollar, I think, is going to weaken as a result of that. And what really held back the gold and gold miners over the last year has been the strength of the US dollar. So as the US dollar starts to fade here, I think that's going to be a huge catalyst for gold going forward.
And that similarly would hold true also for commodities, which are priced in US dollars as well, right?
Yeah. And also with China opening up, who knows the impact on commodities as well. Usually tends to be positive.
What's kind of weird, isn't it, that when that during a year when inflation spiked, that gold, took a back seat. But as you said, it's because of the rising dollar. But it's interesting also, I think what you said, and maybe correct me if I'm wrong, but you said that, higher gold prices will lead to a lower dollar, and a lower dollar will lead to a higher gold price. I mean, I know there's a relationship there, but is there any sort of cyclicality to that in terms of how, how gold is being favored and the dollar is falling?
I mean,
like,
now,
are they mutually, are they exclusive to each other, or is it just, do they go hand in hand?
Not always. I mean, they tend to be inversely correlated. I mean, you definitely bring up a good point there. There are times when they are positively correlated. However, I think the major driving factors for gold tends to be, you buy gold as a hedge for three reasons: a weak US dollar, which we're seeing right now, inflation, and geopolitical or macroeconomic risk. So those are the three reasons you buy gold. Typically when you have, macroeconomic risk kind of increasing, you usually have US dollar increasing as well. And that's when you typically have a strong correlation between gold and the US dollar. But now obviously with, the concerns, geopolitical risk are already baked into risk assets, unless we get tensions rise in Russia and Ukraine, or we get China kind of invading Taiwan, geopolitical risk right now is already priced in, I think. So the main concern is really just the US dollar losing kind of momentum at this point, which should be favorable for gold.
Awesome. Now, last but not least, I want to ask you, because your model portfolio follows a 50-30-20 split between equities, bonds, and alternatives. Is that the correct order? It is, right?
Yeah.
What are the alternatives that you are favoring?
Right now we have preferred shares in there.
Okay.
So that's, that's been in there for a long time just because as a portfolio construction building block, it tends to have, non-correlated returns with both equities and bonds. So that's why we've had that position over the last, I would say, 10 years even.
Yeah.
So it's always been kind of this static position. But, as the ETF industry kind of, evolves and provides exposure to, a lot of this alternative exposures. And with the changes in 81102, that's going to allow the ETF industry to provide exposure into,
Right.
Deeper kind of exposures into alternatives. So long short, you mentioned, I think that's going to be very interesting because maybe long short's going to underperform this year, but I think the importance of long short was really made in 2022 when you had bonds and equities falling, but long short, if it's designed appropriately, is going to give you positive returns in that kind of environment. And the challenge, however, with, when you have certain positions that are considered alternative in areas or years like 2022, when you get this deleveraging in the market or when you get the market sell off, all of a sudden the correlation rises. And, as an alternative, that diversification doesn't really, favor your portfolio when it really matters. Long short, however, that negative correlation still holds up in 2022. So, long short is something we've been considering. Other things like, gold bullion, I think that is another consideration as well. But those are, some of the alternatives that I've definitely kind of consider in that alternatives bucket of a balanced portfolio.
Yeah. Interesting, Alfred. I hadn't even the new liquid alternatives that have come into the market really only came on stream in the last 3 years, and probably most of them in the last 2. So they're still very new in terms of adoption, but I hadn't considered. I know preferred shares have been a favored position in your models as an alternative asset. I hadn't considered that the preferred share strategy as an alternative allocation predates 81102 changes to allowing liquid alternatives to be made available to investors.
Yeah.
In the last 3 years. And of course, we had up until the end of last year, investors had really very little incentive to, look at alternatives other than as a forward-looking exercise. And, that's something that's really hard to, because of biases, really hard to get investors into alternatives when the 60/40 was doing so well right up to the end of last year.
Yeah.
Right. It's only like when, a crisis happens or, like this pullback we had in 2022, that people start to look at their options. It's unfortunate that, something bad has to happen before you start looking at something that's a forward-looking allocation.
Yeah.
That a lot of well-heeled or professional investors would have done in advance of the end of last year, given where valuations were and ZERP and all that stuff, retail investors are not apt to load up on diversifiers when they don't know there's a need to.
Yeah.
Right. So something bad has to happen in order for the, for that impetus to rise to make that change. But Alfred, thank you so much. That was a really comprehensive discussion, and you just have such a great way of elaborating and explaining how things fit together. Thank you so much for your incredibly valuable time.
Always a pleasure to have these conversations with you.
Yeah, love catching up with you, Alfred.
Yeah,
Thank
likewise.
you so much.